Ever wondered if your savings are truly safe? It has been a challenging week for the banking sector, marked by the significant downfall of Silicon Valley Bank, the second largest bank collapse in U.S. history. This year has proven to be tough for American banks, with 3 banks collapsing within a week back in March, the most significant banking failure since the 2008 financial crisis, where over 600 banks failed. A recent study on the vulnerability of the U.S. banking system reveals that 186 more banks are at risk of failure. Even if only half of their uninsured depositors decide to withdraw their funds, the consequences could be dire. Despite the Biden government's attempts to assure the public about the safety of the banking system, concerns persist. Moody's Investor Service has downgraded the rating outlook from stable to negative for 3 major banks in the country: Bank of America, JP Chase, and Wells Fargo. Make sure to subscribe and leave a like below this video. Stick around as we unravel the shocking truth behind the silent collapse of some of America's biggest banks. While global events in Ukraine and the Middle East dominate mainstream media, the continued dire state of the banking industry is alarming. Small lenders are folding nationwide, and major banks are closing hundreds of branches, resulting in thousands of job layoffs. Interest rates are on the rise, monetary conditions are tightening, and most lenders have ceased issuing credit while grappling with significant unrealized losses. In this turmoil, news emerges that 3 supposedly too big to fail banks have experienced downgrades. JP Morgan's downgrade, in particular, is attributed to the substantial risks posed by its complex capital markets business. Moody's points out that this downgrade follows the previous downgrade of the U.S. sovereign credit rating, also shifted from stable to negative. Recession concerns are revived with a damning forecast for early next year, anticipating a mild recession in 2024. Moody's analyst, Peter Enerby, suggests that the weakened banks result from broader economic concerns, emphasizing the reduced capacity of the U.S. government to support systemically important banks. This troubling development for major banks follows S&P Global Ratings' downgrade of 5 smaller lenders just weeks ago. The downgrade resulted from a comprehensive review of risks related to funding liquidity and asset quality, with a particular focus on office commercial real estate. The formidable challenges faced by major banks have become evident through their staggering loan losses and closures. The abrupt collapse of Silicon Valley Bank in March, triggered by a $1.8 billion loss from selling an underwater bond portfolio, offers a poignant example. However, the larger banks are discreetly grappling with similar issues, as revealed by JP Chase's latest report on its overall balance sheet. The banking giant acknowledges tens of billions of dollars in losses on securities, with approximately $40 billion in unrealized bond losses as of the third quarter, reflecting a 20% increase from the previous quarter. This revelation is accompanied by a noteworthy red flag for the banking sector and the U.S. economy. In an SEC filing, JP Morgan announced its chairman and CEO, Jamie Dimon's intention to sell 1 million shares starting in 2024, amounting to roughly $140 million and approximately 9% of his beneficial ownership. This trend extends beyond JP Morgan, as evidenced by Bank of America's recent quarterly report, which discloses a staggering $131.6 billion in unrealized losses, surpassing the magnitude of Silicon Valley Bank's crisis. Moody's estimates suggest. In response to these challenges, major banks are making substantial cuts, ranging from banking space to jobs. Wells Fargo, for instance, closed 20 branches nationally this week, adding to the 160 closures in the first half of the year. Bank of America also announced the closure of 10 more branches in November, contributing to a total of 6 banks filing to close almost 60 branches this month, leaving millions of Americans without access to crucial financial services. The roots of this crisis can be traced back to a 2-year span marked by the Federal Reserve's continuous efforts to maintain higher interest rates. This strategy has led to a historic collapse in bonds, plunging the entire economy into uncertainty. As the situation worsens, failing banks are increasingly turning to the Federal Reserve and the government for another bailout. Drawing parallels with the 2008 financial crisis, where the Troubled Asset Relief Program, TARP, was initiated, the current environment has seen the creation of a similar emergency liquidity program known as the Bank Term Funding Program, BTFP. Under this initiative, banks can borrow from the Federal Reserve using high-quality securities as collateral. Since March, the Federal Reserve has lent over $100 billion to struggling banks, and the utilization of the BTFP has nearly doubled compared to the peak of the banking crisis in March 2023. Undoubtedly, the current state of the financial system poses unprecedented risks, raising concerns that the banking sector might face a collapse as early as March next year. The rationale is straightforward. The federal government is already operating at its capacity, and its financial standing is progressively weakening with ongoing lending. Widespread issues in banks have eroded taxpayer confidence in the country's financial institutions, and there's a substantiated rationale behind this sentiment. The erosion of public trust in institutions sets the stage for more significant issues. When banks encounter troubles, the repercussions are immediately transferred to consumers. The public witnessing the Federal Reserve employing similar pre-recession measures as seen in 2008 prompts them to hold onto their assets. Unfortunately, ordinary citizens find themselves in a losing game as financial institutions pass on their troubles to consumers. An early indicator of this transition is the evident credit crunch noticeable in recent weeks. Federal Reserve data shows a substantial increase in the credit rejection rate, surging by 2.1 percentage points from 18% in 2022 to over 20% in 2023. With impending bailouts in progress, this rejection rate is expected to rise further in the coming year. The impact of this credit crunch on the economy is starkly reflected in the home sales figures. Existing home sales in the United States have plummeted to the lowest level since 2010, reaching an adjusted annual rate of 3.79 million units, a decade low. The mortgage landscape is equally grim, with interest rates on the most popular U.S. home loan hitting the highest point since September 2000, marking a seventh consecutive weekly increase and resulting in a 28-year low in mortgage applications. Housing affordability has plummeted to its lowest since the early 1980s. This distressing scenario, though unfortunate, is not entirely unexpected. Home sales have declined for the 20th time in the last 2 years, contributing to a slowdown in overall spending and consequently a sluggish economy. The upcoming holiday season is anticipated to witness a departure from the traditional shopping splurges, with major retailers expressing concerns about profitability. Best Buy CEO Corey Berry foresees a customer base focused on seeking deals. The precarious situation of America's banks is of immense significance to the general public. Despite this, the mainstream media appears to overlook the signs and lacks urgency in reporting the plight of millions who are struggling. The potential consequences of a complete meltdown are serious, harking back to a time when Americans experienced job losses, capital depletion, and, tragically, loss of life. Your thoughts on these unfolding crises are welcome in the comments section, and if you find this information valuable, consider subscribing to stay informed about what the mainstream media may choose to overlook. Thank you for watching.